everybody. Today we're going to discuss the right approach to raising funds, particularly in the sphere of technology and looking at early stage companies, but moving slightly away from seed to later rounds. We act for maybe 100, 120 SME technology companies, and many of them come to us having previously raised funds from the wrong people at the wrong time and in the wrong amounts. So all sorts of things can go wrong. So today we're going to try and clarify some of the issues and cast some light on how to approach this whole area. We have an illustrious panel. Starting far right, Carrie Osmond, CEO at Cruxy, a technology strategy specialist, advising clients on where and when finance fits into the overall integrated strategy. Next to Carrie, we have Ella Botham, Vice President of Venture and Growth Banking at Silicon Valley Bank. She's got a particular focus on supporting VC-backed entities across the UK and Europe. We then have Simon Moyner, who is a partner at Icon Corporate Finance, helping owners of tech company raise venture capital. He's got a very good perspective dealing with lots of different VCs on how different VCs look at tech companies and the way they present themselves and how you might refine your proposition in order to become more attractive to the right VCs. We then have our very own David Martin, homebred. He's one of the corporate lawyers, one of the corporate partners, and he acts for lots of the technology clients here, all the way from startups to Oak North, advising them on all sorts of corporate issues. A lot of that's fundraising, share option schemes, and all sorts of loan documentation. And as they say, last but not least, the other David Batty over here, who's a specialist in early stage fundraising. So he deals with the areas that a lot of sort of corporate finance people don't go down to because they find it doesn't work for them, but he raised typically money's up to £1 million for the right sort of companies, and he also focus on helping them sort of make themselves investment ready. Each panelist can say a little bit more about him or herself. Take a minute each, by all means, and then David will be sort of chairing the debate, and it's an interactive debate, so do feel free to stick your hands up and ask questions, and then you'll be able to network without handshaking afterwards, obviously, and have some more refreshments and talk a bit more. Thanks very much.
Carrie, would you like to kick off introducing yourself?
Yeah, so Carrie Osmond, founded my company, so Cruxy and Company, 6 years ago. It's been a hell of a ride. I'm sure some of you in the audience have equally had big old journeys of brutal and glorious existence. And I guess what we now do, we've changed quite a lot in the 6 years, but what we now do is work with Series B and beyond companies, and we mainly help them with anything related to revenue growth, so lots of pricing strategy. And for those of you that haven't looked at your pricing strategy, then it is an amazing way to just make a lot of money quite quickly. Lots of pricing strategy and lots of restructuring product into solution sets for different customer groups. So laddering pricing into that. It's quite geeky, but unbelievably interesting. And then also we do a lot of work with private equity, and most of our clients come through investors. So that's kind of, I guess, why I'm here, and hopefully I'll add a limited amount of value. Let's see.
Thank you. Ella.
Hi, I'm Ella Botham. So I work at Silicon Valley Bank. And for those of you who don't know Silicon Valley Bank, we are a tech and innovation specialist bank. So we work exclusively with kind of fast growth, VC-backed tech companies. I work specifically with companies from kind of Series A all the way through to cash flow positive. We do kind of day-to-day banking, but then I suppose more interestingly for many of you maybe, we do a lot of debt financing as well. So anything from venture debt alongside an equity round to kind of slightly more creative working capital solutions or growth term loans.
Thank you. Simon.
Yeah. Good morning, everyone. My name's Simon Moyner, one of the partners at Icon Corporate Finance. We act exclusively for technology companies. We either raise capital or help them advise on their fundraising strategy and raise capital for them at the growth stage, or we advise the shareholders when it comes to exit. So we do the M&A and exits. Just to give a sample of some of the transactions that we've been involved in on the fundraising front. We advised Imogen on their Series B. That was a video SaaS platform, and that was invested in by Downing. There's a cybersecurity company called Century Bay where they did a venture debt deal. A fintech company called Mosaic Smart Data were advised on their Series A and Series B, and that money came on their Series B from JP Morgan, Commerzbank, and Octopus, and then a health tech analytics company we revised fairly recently called Draper and Dash, and that was a Series A with money coming from Guinness. We also do exits and sell companies, as I said, and we've sold companies into NTT, Telstra, which is Australian telco, Accenture, Thomson Reuters, RWE, Empower, Aviva, Aberdeen Asset Management. So we're selling, I suppose, there's a trend of fast-growing tech companies being acquired by massive global conglomerates, and we've been advising on those.
Thanks. David.
David Batty, set up my company 2 years ago. Prior to that, I worked in private equity as a portfolio manager, looking after majority of equity and debt assets, cross-sector. Then I spent 2 years in the family office environment, looking after a portfolio of small assets and helping them go through specific challenges around growth, changing business strategy, bringing on new investment, typically up to about £1 million. And now my business and I focus on the gap before Series A, the post-seed to Series A space, typically the kind of 500k to £1 million kind of funding size, and trying to get companies to that point.
My name's David Martin. I'm one of the corporate partners at SMB. I've spent my entire professional career as a transactional lawyer helping startups, scale-ups and other entrepreneurial businesses across the whole kind of transactional life cycle. So that's from someone with an idea, raising some money to get that idea off the ground, some M&A perhaps along the way, buying competitors, right through to an exit, whether that's by way of a trade sale or an IPO. So to kick off, I think it's worth talking a little bit about where we see the VC market is kind of at the end of 2019, beginning of 2020. I know we see that despite, uncertainty around Brexit or other issues weighing down in certain other sectors, we've actually seen tech being, pretty buoyant, particularly in terms of VC activity coming in from overseas funds, particularly US funds, who I think have a lot of confidence in the UK market. Obviously, fintech has been particularly hot, and I think a lot of those overseas investors are very attracted by the pricing, given the falling sterling, because it feels like the entire country's on sale to them. Carrie, could you maybe give us some thoughts about where you see the VC market currently?
So I think probably other people on the panel are better placed to answer around the earlier stages. But definitely at the later stages, we're seeing, all the investors that we meet are just so desperate to get in on deals. I think you're going to see this kind of desperation to get in on deals. So they're kind of desperate and almost, just all swarming these very few big deals that they're trying to get in on because they're the ones that have the traction that meet with their thesis. So I think from my side, I fear that they're kind of desperately running after the bigger names that have got a bit of PR and a bit of noise at Series B and C, but maybe not willing to take the same risk as they would have been at the earlier stages. It feels like the risk is tilted. They're willing to take this huge risk because a company happens to have a big name and have spoken on every panel under the sun. Oh, the irony. But yeah, they don't necessarily seem to be taking that risk at an earlier stage. So at an earlier stage, they're looking for very solid unit economics. Okay, but that's probably not feasible if it's a really early, seed company. So I think there are a couple of things that we're seeing. And then we do a lot with private equity. And I think one of the things that we think is interesting is how private equity are looking at sweeping up fragmented solutions. So if you look at RegTech and what HG Capital are doing, for example, they're trying to sweep up lots of different pinpoint RegTechs and bind them into one business. There's another business which is doing similar with subscription-based pricing. So trying to just pull in as many subscription-based pricing models for gyms, I think this is, and hospitality, bind them into one company, that then hits an EBIT, that then can go on to the next acquisition in the market. So there are a couple of things that we're seeing change in the tech landscape, I guess, private equity and then the risk profile versus reward at the different points.
Thanks, and definitely we certainly see a lot of that in terms of the VCs being unwilling to invest in pre-revenue businesses, although I did sit on a panel last year and say, oh yeah, if you're pre-revenue, forget talking to a VC. And of course, a week later, a client rang me having raised 1.5 million from a couple of VCs pre-revenue. So there are always exceptions. Ella, in terms of the VCs that you often, I know, work with when you're lending into to borrowers alongside, how do you see the market at the moment?
Yeah, it's definitely growing massively. I'd echo Carrie's point on there's definitely been a decline in the seed and Series A deals, and I think something like 40% of European funding deals in 2019 were like funding amount, was 100 million plus raises. So we're definitely seeing that trend as the investors start to raise these huge giant funds competing with SoftBank. We're definitely seeing an increase in these large mega rounds for the later stage. I guess that being said, there are more and more kind of specialised, slightly more directed funds coming out, especially for the sort of underserved seed Series A market, or maybe underserved groups. So that might be like diversity of founders, or that might be sectors that haven't historically had that much support from VCs. So there's definitely movement in the market, but right now it is quite tough for seed.
Thank you. And Simon, where do you see the market at the moment?
Yeah, I mean, pretty similar to what's covered so far. I think you have had this sort of massive kind of QE impact, sort of just flooding the market at all levels, which is meaning that investors are sort of having to look harder to get kind of higher returns and are prepared to take more risk. So you are seeing sort of more allocation to those kind of big kind of Series B, Series C funds, so they're well loaded. But it's also kind of lowered down as well. Barely a week goes past where I don't see a new fund which has raised 50 million or 100 million to do sort of tech investment at Series A, Series B stage. So there is a lot of money out there. You've also had the impact of like the VCT rules, which is where individuals can invest like tax efficiently, and those and the way that works is that people tend to put their money into VCT funds, and that's managed by a manager who then makes those investments. The rules on what they can and can't invest in have tightened, which is basically good news for tech companies. They have to be more pure tech. It can't just be the recycling of cash. It's got to be kind of proper, clean investments into clean technology companies which are young, and that has also sort of pushed the market. And what we're seeing is, again, probably a bit what David said, the bar hasn't necessarily sort of lowered and means it's now easier to raise money. But if you hit the threshold, there's just many more people chasing those deals. So we're seeing valuations like significantly higher than we ever have done on Series A, Series B and Series C as well. So valuations are very high, but the quality still needs to kind of meet that sort of threshold.
Thank you. David, what's your kind of perspective? I appreciate it's always difficult coming
No, I have nothing else to say. No, what I would say is just switching it slightly away from VCs per se, is that a lot of family offices now are moving into direct investing as well, competing typically with where VCs might sit. So aside from having floods of money channeled into VC at the moment, family offices are being more confident in their direct investment capability. So that is also causing some dislocation. And in any part of the market where there's too much capital, valuations are going to move only one way, because people are going to fight over less and less deals.
And do you think that family office funding might be starting to help bridge what we see as a gap between you can get the seed money under SEIS and EIS, and then once you're kind of generating decent revenue, you can talk to VCs and raise, a few million, but there's kind of a gap in between that we find a lot of our clients can find themselves stuck in, where they've got a minimum viable product, they're possibly, marketing or about to market, but they're not generating enough revenue to make a VC feel comfortable that this is a lower risk enough proposition. Do you think that's an area where family offices might be willing to help?
Yeah, I think typically the type of business you're talking about there is one which fits very much into kind of the discretionary capital pool. So you're looking at EIS funds, you're looking at family offices, you're looking at groups of individuals, ultra high net worth, and actually that is very difficult to fund anyway because it's all discretionary. There's no pressure to put money to work, so it has to fit an exact profile, and the matchmaking, it needs to be that little bit smoother, more refined. So it's still very, very hard. And I would say if anyone's looking in that space, you need to talk to as many people as possible, because your chances are that little bit slimmer, I think.
Can I just add in as well, the other thing which we're seeing in the market is corporate venture capital. So big corporates have their own funds to invest in tech companies, and that's been making a big impact on the market as well. A lot of the big banks have got their own funds to invest in fintech companies, not just the banks in London, but also we're seeing sort of Japanese coming into the market more. So of the sort of 7 or 8 largest Japanese companies, they've all got funds, they're all setting up in London, they've all raising, as I said, sort of 50 to 100 million for their funds to investing in tech companies. And so those are making a big impact as well on the market that we're seeing as well, and they're kind of a useful place to go to raise capital as well.
Thank you. So we've talked a little bit about, VCs are often, they're looking to see some revenue, some the product being finished and some traction in the market. You mentioned, Carrie, that you spoke to a bank that's looking for businesses that fit their theory of where the market's going. What else do you think, Carrie, a VC is looking for when it makes an investment?
Oh, big question. I guess going back to David's point, and I guess just to lightly challenge you, David, on this kind of meet more people. I guess this ties into like what VCs are looking for, and I think I said this last time I was here, so hopefully if there's anyone who was here last time, I'm really sorry, I'm just repeating myself. But I think just being super clear on the thesis that VC has, like what stage do they invest? Do they lead rounds? What is the sweet spot of their technology? If they need you to be at 10 million revenue, because that's what they've sold to their LPs, why are you meeting them if you're at 2? And if you are meeting them because you're at 2 and you're meeting them with a view that you want to know them for when you're at 10, like say you're meeting 8 Roads because you just think they're a great name and I want to meet them, that's fine, but don't think that they're going to invest in you. I think we just see a lot of people who are kind of doing this spray and pray, methodology, like, oh, well, I'll meet 100 VCs and then be gutted that 80 of them don't reply to my emails. It's like, but they're not going to. They don't invest in people at your stage, they don't lead rounds, they don't invest in that type of technology. Have they backed a competitor? Have they backed something with an adjacency to what you're doing? And I think those types of things, even just the ethos of the partners of the fund, like do they feel a good fit with you? And I think if you do it that way, you can actually meet a lot fewer, because you can become very intentional about what exactly is it they're looking for. I guess it's exactly, like sales. Get under the skin of exactly where you add value and why and how and who's most relevant, and go and have really on point conversations with that group of people with a very clear unit economics, clear kind of this is how I'm going to get from A to B, this is what it's going to take. I still see lots of companies, and sorry to don't shoot the messenger, but I still see lots of companies who I think haven't actually worked out what they need the money for. And it's like, the reason I haven't raised money, obviously I run a consultancy, so that would have been a crazy idea, but I'm now building tech into it. The reason I haven't raised money is because if someone gave me 10 million tomorrow, there is no way for me to scale the company with 10 million. I'd spend it all on recruitment, I'd probably pull recruitment in-house, but that isn't enough. I don't need 10 million to do that, so that would be crazy. I still see a lot of people who actually at seed don't really know what they need the money for. So then they haven't worked out what then the bridge from seed to Series A needs to be. So they raise a seed at 500k because they think that raising 500k sounds sensible. And then they find themselves in that void between seed and Series A. But actually it's because they haven't done the hard work to work out what they really need. So that's my brutal opinion.
Thank you.
Literally someone's leaving the room right now. The ultimate custard pie.
Simon, when you're working with early stage tech businesses that are looking to approach VCs, what are you telling them that a VC is going to be looking for and that they need to kind of, make sure stands out in their pitch deck, in their presentations?
Yeah, okay. Yes.
Sorry.
Could I ask, when you're answering this, to kind of qualify what stage the VC would focus on? Yeah, would be helpful.
Well, maybe I'll just give a kind of headline metrics. I think if it's sort of Series A, an investor would typically looking for kind of around about 10 times their money back. Series B is probably kind of five upwards. And then when you're sort of dealing with private equities, they can double their money. That's kind of where they play. So those are sort of the typical benchmarks. So you need to have a plan, have a product which can give people those sort of returns at that different level. So if you're asking for 5 million on a Series A, then obviously do the maths, and you've got to be able to sort of show them how they're going to get 50 million pounds back. So it's you've got to have that plan, as Carrie said, to know how you're going to deploy that money and how you're going to sort of use that money to kind of get you to a scale where you're going to be worth, in the Series A, 10 times where you are today. So it's got to be a sort of tough. It's a tough. That's why the bar's hard to raise money, from the institutions, and similarly from the Series B as well. You've got to be able to sort of show the plan. By the time you get to the Series B, you'll have more sort of organisational infrastructure. You should have a CFO who will help formulate those plans. But again, you need to be sort of clear on those. And in terms of what the investors are looking for, again, it depends a bit on the stage. The earlier it is, the more emphasis on the management team. But they're all looking for sort of management team. They're looking for sort of IP. They're looking for barriers to entry and a set like a addressable market. A decent sized addressable market. Those would be the sort of 3 or 4 things that the investors are looking for. And as you go through the different stages, that weight will change. When you're at a Series B, management's still really important, but by that stage, they really want to see evidence of traction, and that kind of becomes more important.
I always think Series A is usually the point where most of your challenges and barriers to or hurdles to scale haven't been fully solved, but they're mostly solved. So the cash is being used to allow you to expand your product development or expand into new markets or different strategies.
Typically as well, we see on the institutional, for the investors, whether it's a Series A or Series B, they don't really like to take technology risks. So they want to be putting money, and they want to see the money going into sort of sales and marketing and growth. They don't want to see £5 million to spend on developers and not quite sure what's going to come of it. So they do want to make sure that product's sort of defined and safe, scalable, and then really the money's going into 80% of that money is really going for that growth.
How many Series A's that you see have actually got to that point? Because I love the theory, but we're seeing Series A's all the time, like really successful raises where they, to be honest, they actually are fumbling for product market fit. They haven't got, so I think there is obviously a void between, of course, the investors are sitting there saying we want all of our money to go on sales and marketing and driving top line. But I think from our perspective, we're still seeing a lot of companies that have raised a big Series A round who are actually not in that place at all. Yeah. Or they go and hire the salesperson, then they fire them, then they realise they haven't got product market fit, then they literally go kind of backwards. And I think that would be probably still the majority of companies we see between Series A and B. Like, love the theory that they use the money to go and expand into new markets, but most of the companies we know expand too early into new markets and then they have to extract themselves back because they realise that. So I think there is this, be careful what you say to a VC, because they are also a human being who's going to see the reality of your business and say, well, actually, this sounds ridiculous. You're no way in this position. What are you saying? So I just think you've got to balance that.
I think it's fair. And sometimes they'll see the management team really kind of back that management team, and maybe they haven't got that sort of that product quite as far along. But generally, I think if you're going to a VC and you haven't got that product sorted, you're going to be finding it really hard to raise money. Is the message I would say is unless you've got that product sort of sorted and you can show it and you can show people actually kind of paying you money, not just a pilot but paying you money, then it's going to be hard to raise the money. The other thing I would say is, it's what Carrie said about just be careful of sort of over-promising, because you may say, we need 5 million to do this, but if you end up sort of running out of money before you've really got to the stage where you can raise the next round from third-party investors, you can find yourself in a bit of problem because you're having to go back to your existing investor to ask for more money, and sometimes the terms won't be as favourable for yourself on that basis.
I think, Carrie, your point also around some companies not being ready at Series A, I think that very much depends on the type of technology and the depth of technology. So if it's a very heavy, deep tech product, ultimately you're still going to have a bit of discovery to do on the product and the product development and the fit. If it's a more simple e-commerce type platform, then those things are easy to have fixed before you get to Series A.
So one question we get asked a lot is, how much money should I raise? How much, runway do I need? And sometimes it's quite easy to help the business work out how much money they need, because they've got a business plan that says, right, to get to MVP, it's going to cost X, and then maybe it's X plus a buffer for contingencies, and accepting that fundraising always takes longer than you expect. But maybe starting with you, David, when you're sitting down with businesses and they want to know how much to raise, what kind of advice do you give them?
I would say that most of the companies I see tend to think they have a very clear plan of where their marketing is going to go, where their staffing is going to go, but ultimately they forget things. They always forget things. They always forget the cost of bringing on new people. So recruitment fees always missed, legal fees always missed, employment contracts, all those kind of things. Those kind of things always get lost in the mix usually. So I always say, look, go through every single line of your P&L, add 20-25%, and that gives you a little bit of flexibility if you hit a few bumps on the road. I raised some money last year for a small, actually, consumer products business, and now we have issues through coronavirus. Now, you can't really mitigate for that, but we raised just about enough to allow for some disruption there, but I'm still pretty worried about where we're going with that business. So always give yourself a little bit more than you expect at every stage.
Thank you. And Simon, what kind of advice would you give?
Yeah, I think it's got to be driven by your financial plan. I think that was a point someone touched on earlier, that you've got to raise the money to fit to your plan. I think the sort of exception would be if you've got lots of people sort of chasing you down for the money, and you've hit that threshold where lots of investors are interested, then and the valuation is good, then definitely raise more. It's easier to raise money when you don't sort of need it. So if there's more money on the offering at a good valuation, then do take it. But I think your starting point is, what do we need to achieve our plans, and it's kind of looking at that financial plan, which then drives it.
So Carrie, I know you touched earlier on, talking to a lot of companies that have this number that they want, but don't necessarily know why they want that number. What kind of advice do you tend to give them? Is it just as simple as sort of sit down, work out what you actually need, and ask for that, or is it more nuanced?
I guess from our perspective, it's kind of a combination. So where are we today? What's the point of departure? What are the costs that we're taking on to achieve what? Are there kind of areas of the P&L that are, let's be honest, there's like fat in the P&L, or we've overhired, or you should still be always assessing where you are today, not just thinking add without thought, I guess. And then I think what Simon said around working out where you really want to be, what's the stage you're at, and what's the return that investor's looking for from that money, and then mapping out kind of what are the key things that we need to do to get to that point, and also making sure that those are choices. Because I think we still see quite a lot of people saying, well, we're going to enter the US, and we're going to launch this product, and we're going to go into this segment. And obviously we would normally say, well, actually, strategy is the art of sacrifice, so what are you not going to do? And I think it is also a really good backup slide to have in the appendix to say, we thought about these different initiatives. We've killed these ones based on limited TAM, like lack of traction. We don't have the ability to win there for these reasons. We're going to park them for potentially Series B or C, but at this stage, these are the decisions we're making. And then exactly to kind of David's point, for me, I would expect those to be backed up with like a mini P&L for each initiative. I'm very numbers orientated. So, the P&L to enter the US, it's going to look like this. It increases travel by this. It means the CEO is not going to be here X% of the time. It means we have to bring in a GM at year 2. What are all the decisions that you need to make that are going to affect the P&L for each of those initiatives? Let's say, just because 3 is a good number, if there were 3, and then you can break down the raise and say, well, we're raising 10, X% is going on team under this initiative, enter new segment Y. How many people we need? 4 salespeople for that. We need to add this cost. So I think it's just breaking it all. I know it sounds very kind of probably complicated, but I think it's just breaking it all down.
Yeah, definitely you need a bottom-up forecast. You do, especially for the first 3 years, you need a bottom-up forecast of by people, by location, by and then on your income side, by your income streams on a monthly basis. That's what investors need. So you do need to have that. And to do those bottom-up forecasts, you need to have gone through that thought journey and process of saying, who do we need? When are we going to hire them? What are they going to do? What other bits do we need to put around them to make that work? So it is just...
I think it's quite good to do it by growth initiative, because then it forces you to think, is entering the US the right thing to do at this point? Or is, changing our pricing, right? We do have companies who we're working with, and they raise Series B, and in the Series B deck, they say, we are going to change pricing. This is who we're hiring. This is how much it's going to cost. This is the return we expect from it. So they actually put it under as an initiative. And I think that's quite a clever way to do it, because it forces you to go through the depth of thinking, what do I actually need to do well in this segment? Or should I enter the US, or should I actually leave that, for example?
So, Ella, I know that SVB has debt products that can be combined with a Series A or other funding round. Would you find, can you talk us through a little bit of how those products work? And do you find they're used to kind of help the company raising money get to the amount of money it needs, or to provide a buffer for contingencies, or to allow them to actually just accelerate growth even faster than they would have without that debt?
Yeah, so I guess the first thing I'd say is that if we take venture debt as an example, because that's kind of the first piece of debt you'd probably be looking at, and that's sort of the bread and butter, that really is complementary to an equity round rather than supplementary. And that's quite important to remember, because we're still talking about, cash burning, normally nothing really in the way of true assets. It's still truly equity risk. But where venture debt can really help, so we typically look to put it in alongside or soon after an equity round. And we've kind of been talking, so if you take Series A, for example, absolutely it's so important to make sure that you've built in enough buffer, because, the companies we work with, you can have the best, you've put so much work into the plan, you've got all the best intentions, but things change, like take coronavirus, you can't foresee that. Or for the best reasons, you might have some kind of pivot in your company strategy because you've realised actually you need more investment in the back end, or actually this market you were going into isn't as strong as this market. So there are lots of different things that you can't necessarily foresee. So yeah, we see venture debt used in all those ways, to be honest. So some people like to use it when they're raising equity to help dilute to help reduce the equity dilution. So for example, if you want to get to 10 million and you know that you need to raise 10 million in total to get to your Series B, for example, then maybe you raise 7 to 8 million in equity and then 2 to 3 million in debt instead. And then others will use it simply to provide just additional cash buffer. So you've gone out, you've raised 10 million. Like we said, there's so many things that can change. Get some extra cash in to help push through. And we've seen it work really, really well with a lot of companies. I've had one recently who we put debt in alongside their Series A. This was an example where the company strategy actually did pivot for the right reasons, just because they were having early Series B discussions, and all the Series B investors were giving them, to be honest, quite different metrics to what they'd originally thought that they needed to track to. So what it meant was that the debt we'd put in helped to push through to be able to prove those further metrics and get to the Series B, whereas otherwise they'd have really struggled with that piece. So it's a really great tool. I think we also see it used just to purely accelerate growth. So you've raised 10 million, you know that 10 million takes you to this point, but if you can spend 13 million in that same time span, then you can invest more in marketing, you can invest more in hiring new people, and you might have been aiming for 3x growth, you can get to 4x growth, for example. So yeah.
On these venture debt products, you mentioned like 10 million as a number. Is that like a reasonable deal size where you're kind of getting involved in, or do you tend to get involved in earlier than that?
Yeah, so we'd normally say about $5 million would be the minimum. So the minimum raise, exactly. So typically we say a meaningful Series A of 5 million plus. And the main reason for that is the right amount of venture debt typically to be putting in alongside the equity round is like we say is about 20 to 30% of the equity round. And the reason for that is making sure that we're not over leveraging. No investor wants to come in at Series B just to repay like 5 million, 10 million in venture debt. Because ultimately the repayment source is always going to be that next round of equity, because you're cash burning, you're probably going to continue to be cash burning for the foreseeable future. So I suppose 20 to 30% of the equity round, and then also most venture debt providers will only work with institutional VCs. That is just to make sure that there's just a little bit more structure in the way that the institutional VCs are kind of continuing to support the company, rather than high net worth angels. That fantastic sources of capital. There's just not the same certainty of future funding for a debt provider.
What sort of pricing is that debt coming in? Yeah,
so if you think about venture debt being the riskiest and the most flexible form of financing you're going to get, so there are no covenants. It's obviously at a time where, like I said, there's nothing really in the way of true assets to lend against or cash flows. Pricing tends to be somewhere between, it depends who you're talking to, 9 to 11%. It can go a bit higher with some of the venture debt funds. And then there's a warrant element as well. So there'll be in effect, a small equity portion, but that normally backs into kind of 1% FDO max.
So the other big question that we get asked a lot, and as lawyers it's not always easy to answer, is valuation. What valuation should we be asking for? Now, we're always cautious about overvaluing a business. It's great if you can get that value now, but there's probably going to be another funding round, and a down round isn't a great story to tell investors, and it can really upset your existing shareholder base. We sometimes talk about comparables, although I know, several of the professional investors we act for say, actually they almost use comparables and work backwards. They fixed on the price and then they look around for comparables that support that, rather than the other way around. Maybe starting with you, Simon, how do you kind of look at setting a valuation for a business that you're working with?
Yeah, no, that's good question. I think probably two things to say. One is obviously there's a level of return which the investor needs to kind of hit. So like we said, like on a Series B, it may be sort of north of 5 times. So you've got to make sure the sort of the valuation, the amount of money you're raising and how much of the company you're giving away and what the future plans are, gives them that sort of level. So that's a good starting point for kind of thinking about valuation. Often companies are loss making, their revenues may be quite low, so kind of trying to apply like traditional EBITDA metrics and ARR metrics is sometimes just gives you no sense. The answers are just like off the scale. So those aren't actually kind of that helpful. But really what drives the value is the market. That's what really drives the value, is the market. So it's when it's the situations that you're seeing at the moment where just people just saying, I just need to get in on that deal, and they'll just pay an extra 20% on the value just to get in it, and that's where you see the share price kind of not go up. And we've certainly seen valuations double through the kind of course of running a process to raise the money. So that's pretty common. And then when you sort of try and reverse comp it back into an EBITDA or ARR multiple that's like outstanding. So that's the main factor which drives the market. It's just number of people wanting the deal.
David?
I don't have much more to add. I mean, that's pretty comprehensive, to be honest. Fully agree.
Great. So, Carrie, you talked about when you were looking to approach VCs, not adopting the spray and pray model, trying to be quite targeted. How would you advise a business to shortlist the VCs to approach beyond what you've kind of already said about, making sure that if that VC has particular investment criteria, the opportunity meets those criteria? Do you think, say, added value that the VC has, expertise in that particular industry or subset of the industry is particularly valuable? Should it be about kind of personal fit?
I guess it's kind of a combination of all of the above. In terms of the practicalities of doing it, I mean, I just think a lot of people would rather go and have a meeting and have a coffee than they would sit and do an Excel spreadsheet of literally scoring. You can literally get an intern, like we have got people to do this. We have this all on our CRM because we work with a lot of investors. And it's like as basic as going on their websites and looking at how many companies they've backed. Here is a score of a percentage of their portfolio that is in SaaS, if you're a SaaS business, for example. At what stage did they invest and what was their ARR when they did? So going back and looking at Crunchbase and things like that. Obviously, partners that led the deal, don't go and meet someone who didn't lead the deal, don't go and meet, they're all very obvious things to say, but for some reason people don't really do it. So I think it's kind of easy to say, oh, it's so obvious. But I guess we still meet a lot of people who are going to meet people, losing self-esteem and losing confidence because the meetings don't go so well. But if you're meeting someone who's never invested in cyber and you've got a really complex B2B cyber offering that is basically a kind of, a kind of BAE system sale type, and you're talking to someone who doesn't even understand what resilience means, then probably you're going to be really annoyed by all those meetings and they're not going to go very well and they're going to feel annoyed because you're going to end up educating them on the sector, which is fine if you want to do that, go and have those meetings, but don't be annoyed that they don't move forward. So I think we all often say, we do it a lot with strategy, play to win, play to participate, do not enter. I'd start to create a list of do not enter. These are just not funds we should be meeting or talking to. Play to participate might be funds that you think could be interesting for the next round, or they might be just big names that you want to connect with because they're good for a bit of word on the street. Don't underestimate the fact that, as Simon said, people start talking about you and then that creates that snowball effect. But then you'll play to win. You can probably create a list of 8 to 12 investors that will probably end up being the ones. I don't know what your thoughts would be, but yeah. I just still see a lot of people being annoyed that the meeting with 8 Roads or the meeting with Atomico didn't, it's like, but they don't invest in your set. That's crazy. They don't even understand how trading platforms work. That's just not their market. If Index have backed a scooter company, are they the person you want to meet if you're, do you want to meet that investor if you're a B2B big data platform applied to GDPR? Probably not. So it's all very obvious, but that's still my obvious thoughts on the subject.
Yeah, I agree. There's definitely a lot to be said about making sure that they're the right fit. And then I think also making sure that you understand and you've thought about what you actually want to get out of your VC, because they do differ so much. I mean, some will be so much more hands-on, which really suits some founders and really does not suit others. Some will be much more standoffish and, a less experienced founder might be like, no, I need someone to be hand-holding me throughout this early process, for example. So I think thinking about that piece as well as are they experts in your particular sector and have they invested in that type of company before, and obviously making sure that they're the right fit stage-wise.
I think also it's well worth getting, if you do have 3 or 4 interested parties, getting proper feedback from people who've had investment from them, because they might tick all your boxes from a qualitative basis, but actually if they're complete arseholes to work with, you don't want to be spending the next kind of 7 years of your life around a board table with them, because there are a few out there like that, I'm sure.
And is there anything else when you're shortlisting, not just between VCs, but when you're helping clients who are maybe, you know, they've got an angel investor interested, they've got a family office, and they've got VCs, anything that, you know, you would talk through with them as to who to approach, or, you know, who should be the front runner if they're in the very nice position of choosing where the money comes from?
Have I had that situation recently? I can't think off the top of my head, to be honest. I think when I advise most companies in my space, it's about understanding what type of company you are. So, do you have the potential to be a proper VC-driven company, or do you fall a little bit short of that? And raising through VCs is going to be that little bit harder. Do you end up falling into the kind of the EIS fund VCT group, which is less demanding, but actually you could be a £50 million company, and actually that's a fantastic return, but you may not be a £200 million company, and it's a very different journey. So understanding what type of investor is right at each stage is quite important.
Would you mind giving a high level different like groups, like what is a VCT type VC versus
what is a VCT? There's only VCT. VCT, I would say, is typically less demanding money. It's usually high net worth money. It's usually individual money grouped together. So they're looking, I would say, for a slightly low return, slightly less driven in terms of their approach, I would say.
Yeah, I think they're more conservative as well. So while they're maybe sort of less punchy on certain aspects, they also just don't want to lose money as well. So they have got that sort of fear of losing money. And then as you go, so that's the sort of VCT, and those VCT funds, you know, those VCT monies are managed by fund managers who are sort of, you know, professional investors, but a lot of them will just come from a finance background. They won't necessarily be sort of sector specialists. They'll be investing in, you know, an IT managed service company one minute. They'll be trying to do a bit of deep tech another minute, but maybe not that well. Another time they'll be doing retail. So they are generalists. And as you get into the institutional VCs, they are much more specialised at tech and subsectors of tech that what they're really focused on. So they'll have institutional VCs who say only fintech, or institutional VCs who only say sort of deep tech or AI. So you have got these specialist sort of groups out there. And
there are EIS funds that do specialise in certain sectors as well. So I think Simfans here as well. They're technology focused. I think 24 Haymarket are generally consumer driven. So there are groups that specialise in different sectors.
And I guess on the VCTs as well, they can be great for that earlier stage, but they do have limits in how much they can invest in any annual period and over the course of the life of their investment in you. So I think it's 5 million a year, and then depending on your kind of capital intensive status, 12 or 20 million.
But to David's question, you want to be, when you're choosing your VC, ideally you want to be kind of putting yourself in a position of choice. So you're meeting kind of several VCs, trying to get them all to make offers at roughly the same time, and those competing offers is what drives the price. But also, you know, you get a flavour of who you want to work with. You know, as you're running the process and meeting with them, it's, you know, you have several meetings with them, just how they conduct themselves, and as David said. Yeah, kind of referencing them. They'll be kind of doing lots of referencing on you and checking you out, but you can also sort of see what else they've invested in and speaking to those kind of founders that they've invested in. So, you know, you do want to be kind of putting yourself in a position of choice.
Yeah. I think also what can they offer you? So if you are in that lucky position where you've got people fighting over you, then some obviously will have much more sector expertise and links to industry, for example, and be very active in introducing you to corporates or other companies or whatever it may be. So making sure you ask those questions too.
Yeah, and I guess not making sure that when they say, well, we help with talent and we've got a platform and our platform will enable you, like, okay, what am I paying for that? Oh, I'm paying you for that as a managed service fee on top of your carry, on top of your LP. Like, I think just getting into, I know it sounds very specific, but okay, if you're really good at talent, what is the network you bring? How have you got that structured? What would that mean if I need to bring in a CFO for Series B? Like, who would you suggest? And if they kind of go, then you probably know that they might be saying that they've got this talent pool, but it might not be the reality. So I think just digging into kind of, it'd be great to have an example of when you've done that with a firm. And they'll be like, either there'll be a quick answer, which you'll be impressed by, or there won't be.
And so then moving on to the next stage, you've shortlisted the investors and VCs that you want to approach. You've set up the meetings. What do you need to bring to that meeting? I mean, I guess the classic one is the pitch deck. And what do you think should be in that pitch deck?
Yeah. Shall I start? Yeah,
Yes,
So, okay, you set the meeting up. You're going to meet the investor. If you've got a pitch deck, not more than 20 slides. Only 1 or 2 on the market. A lot on the team. If it's leading with the team who's going to be running it, and then really sort of getting into the product. Again, not too long on the product, but then really about how you're going to scale. That's what all these investors in. How are you going to scale? How are you going to hit your forecast? What are any metrics that you've got so far? Make sure they're clear and concise for those investors. That's where they'll be focusing on. The more data points you've got, that really kind of is where they get their confidence. So giving those data points is really valuable. So cost of acquiring a customer, obviously kind of recurring revenue rates. If there's anything on churn, it's probably too early for that. But just those kind of key SaaS metrics if it is a SaaS company. Yeah.
Well, having KPIs in your deck shows that you understand your business and understand at least that you're controlling it at a certain level. Yeah. I see a few decks with, let's say, spurious KPIs, but at least they've given us some thought process around how to put them together. And also, if you're going to put a deck together, make sure there is at least 1 page on financials. I see decks without financials, which I find astonishing. I don't want to have to look in a deal model to understand what's going on.
And Ella, if a business is looking at raising some venture debt at the same time, is there anything you particularly want to see?
So to be honest, the due diligence that we look at is pretty much aligned with what you'll be providing anyway to the investors. Obviously we're going to dig really deep into the financials. We want to understand the business, and we'll be looking at the pitch deck and things. I think one of the biggest due diligence areas actually for us is talking to your investors. So if you're raising your Series A, then we'd want to know who those investors are, for example, before we're putting anything in, and we want to be talking to those investors to understand their rationale, to understand kind of what they're tracking the company to make sure that we're aligned with that, and also a bit around their kind of reserve strategy, the fund structure, how they're going to support in a downside scenario, or maybe delays for the right reasons, things like that. But that's, okay, I suppose, another reason why it's best to look at raising debt alongside the equity round, so that you don't have to duplicate those efforts.
So in terms of transaction, we normally come on board at the point where there's a term sheet and we're ready to move into due diligence and documentation, and we often get asked, how long is this going to take? Can we make it quicker? And I guess one of the big bits of advice, we always give clients when they say, like, we're thinking of doing a fundraising, Q3 or 4 this year. So it's not immediately, but we'll come back and talk to you later. We always say to them, start getting investor ready, start getting your, ducks in a line, get all of the boring documentation that your investor, if they're doing due diligence, is going to ask for ready, uploaded neatly into a virtual data room beforehand, so that you're not scrabbling around, once you've signed that term sheet, trying to find all the employment agreements properly signed and dated, and find all those customer contracts that are actually saved all over your system in different places. And the other classic issue that comes up a lot is you paid for some development to be done, externally because it was good value, but you forgot to get an assignment of the IP rights. And it's something that, investing in a tech business, IP is always key, is really a concern for investors. What advice would the panel, and I'm going to open it up generally, would you have for making the whole process, once you've reached the term sheet, smoother?
From my advice, if it's Series A and above, I would make sure you have a decent corporate finance advisor. because there's going to be so many challenges through the process anyway, that relationship management that you don't want to be doing whilst you're trying to run your business at the same time, that having someone on your side, and they could be a very experienced CFO as well, but generally advisors tend to provide a different input. That would be my number one advice when you're raising serious amounts of money.
I'd say not underestimating how long the process will take as well, and making sure that you're prepared well in advance. We have a lot of companies who will have sort of 3-4 months of cash left, and we kind of go to the table asking them what the plans are, and they're just starting to look to raise, which is a bit tight. I'd say minimum of 6 months, but definitely having conversations as early as you can to warm investors up.
Yeah, I think like on that DD piece, it's a tough journey. You know, people describe it as having sort of 2 jobs at once. You know, you're running your company, and then you've got all these questions, and they're so many of the questions are just benign. You know, wanting to know, you know, have you paid your service charge on the premises? They're really like detailed, finicky questions, but you've got to just have that data at your fingertips, and it just totally really sort of gets people down. And so the more, like as David said, the more prep you can do of just getting your hands around all those legal documents, all those agreements, and just getting them into the data room, certainly that will sort of help you. Obviously, we would say, have an advisor on board definitely helps. Have a good lawyer on board to sort of who knows, who's done deals, who understands what's sort of reasonable.
Thank you for gesturing at me. Appreciate it.
So having a good lawyer on your side as those as the investment agreements are being drafted as well. But you've got to be prepared as Ella said. It's not sort of, oh, we've got the term sheet, we're done. There's still a journey to go to get it done, and it can, that DD process can be 8 to 12 weeks, it's 3 months potentially. So you just got to be prepared to sort of really kind of knuckle down and just respond to things as quickly as you can. And there'll be temptations just to fight things, but it takes more time to fight some of these information requests. You're better off just responding and just turning it around as quickly as you can. And the quicker you can get that momentum into that sort of DD process, just the whole thing will be much quicker. So that'll be our advice.
What type of stuff do you think is reasonable? Like, in my experience of raising capital, I think I've got a lot of questions which I would have kind of assumed to happen after the DD process kind of officially begins. Like, what type of stuff should we feel comfortable as founders to be like, that's going to wait until after the term sheet? Or is there a way to go about this?
So what do you do before and what do you do after? Yeah. I think, so before, like DD is generally confirmatory, so they should have done their evaluation, they should have got their thesis, and it should just be confirmatory.
If someone's asking for information to give you a term sheet, they're not going to give you a term sheet without that information. That's my opinion. So if they're asking you for detailed customer feedback or to speak to a customer before DD, that's quite weird, I agree. But I would think if they're asking me for that without a term sheet, then they need to do it to feel confident to issue a term sheet. That would be my gut feel.
And it depends on their internal processes as well, right? Because they might have to go to committee to talk about it and need that information before they go to term.
But I think the question was, when should you push back?
What are the things that are weird that people shouldn't realistically be asking you before the term sheet?
I think doing customer reference calls is probably unusual to do before, but we have let that happen. When we've known who we wanted to have and we've got an idea of where they are on the valuation, but for them to confirm that valuation, they really wanted to know, these 2 or 3 customers were really going to be, tripling their deployment of that particular company's software. So they just needed to do that before they could stand in front of an investment committee and say, we want to put this amazing valuation on this company when. So there's a bit of, and that's why sort of being close and having an advisor to know what's reasonable and what's not, and to say, we're pretty close to this, getting these guys on the hook. They've got to go to our investment committee, but this guy is not going to stand in an investment committee with that valuation without knowing that these 3 customers are going to sort of treble their orders with you. So it is a bit, there is sort of uniqueness to each situation, but generally, customer reference calls you wouldn't do before you've got a term sheet. If they're starting to ask for all your employment contracts, again, that's odd to ask for. But VCs like know what they're doing. They don't want to do a lot of DD before they've put a term sheet down. They want to be getting their sort of exclusivity as quickly and as early as you can. And you're actually wanting to kind of make sure they've really evaluated the opportunity before they've made that offer, because you don't want that evaluation happening when they're under exclusivity, because that kind of increases your risk.
The beauty of having an advisor is generally that you can relay all your bad messages through them, and they can take all the flack for it. Basically, that's the beauty of it.
I think there has to be an element of trust, to be honest, as well. We get a lot of people who say, yeah, there'll be questions, whether it's equity or, to be honest, on the debt process as well. There's a lot of like detailed company questions that will be asked, and companies are reluctant to give it, saying, you know, it's sensitive information. But you have to remember, I suppose, these are businesses, like the investors or debt fund, whatever it may be, are obviously looking to put money into your business, and it's kind of crucial information. You just have to trust that they're going to use that information in the right way.
Just a point on process, which is very practical. I'm very practical. But one of the things I've seen founders do really, really well is if they don't have an advisor, because I have heard some Series A investors say that they prefer them not to. I think that's very just nuanced depending on what investors. I think Series B, they think it's much more normal. But where they give at one point person, so they're like, right, the COO is in charge of this process. There will be a Monday, Wednesday and Friday morning call at 7 a.m. where we will all join, all parties, and be like, and they manage the process. So they have a point person who's accountable for that data room. Obviously, they're then saying, right, we need a customer reference list, pre-call them, make sure they're ready to go, get time in their diary. So they kind of basically almost, I guess, do a little bit of an attempted corporate finance job, but through a point person internally. And I've seen that work quite well. And things like, even if they have a corporate finance advisor doing like a set time to just, are we keeping momentum here? Is everyone actioning? Because obviously it's really easy when you've got your day job to lose sight of, oh, there was a request for something and it's fallen through the wayside. So I've seen that work quite well.
Was there another question at the back?
How do you square the circle of the runway that one needs because it's a 6-month process, the quantum that you're actually raising, the amount of time that you take out of the business to actually run the process, and the valuation that you achieve? Because if you go early, and if we're talking a 6-month timeline in a business that's 2 years old, that is a bloody long time, and they will achieve a hell of a lot. So the valuation at the start of that process is probably fundamentally different from 6 months down the road. How do you square it? I'll give you a $5 if you can.
Yeah. Like, you know, that's like timing your run is kind of what that kind of comes under, and it's great. Yeah, great question. And as you said, there's multiple variables that you're feeding in, and like obviously the later you leave it, the more chance you've got of hitting the metrics, but you don't want to sort of run out of money. I mean, clearly you can't go too early because otherwise investors aren't going to be interested. So you've got to just be at that point where the investors, you know, are going to be interested. So you've got to be hitting your sort of your KPIs, which kind of are relevant for that particular investor group. So you've got to be, you know, there's minimum stage that you need to be at, and then clearly if you've only, you know, and then it's sort of working back. Okay, well, if it typically takes 6 months, then we probably want to put a bit of buffer on there. So you probably allow sort of 8 to 10 months before you run out of money. Would be my advice, because you want to, you know, when you're raising the money. Pardon?
How many businesses would give themselves 8 months to actually raise a Series A or slightly below Series A round?
I mean, I think the answer to that is that you are always fundraising. You don't wake up one morning and say, right, I'm going to go and get my Series A now. You're part of the CEO founder's role is constant fundraising. And so, you know, you might be a year ahead, you start the conversations with the VCs, and you try and build a relationship with them in a lot of cases, so that, you know, it's a continual discussion as you get nearer and nearer to the 6 months, 3 months, and so on.
It depends a bit on your capital structure, that you've got in place, because it could be that you're, as it were, bootstrapping it, and actually, and that's sort of giving you kind of modest growth or giving you enough KPIs, but you haven't bet the business that you've got to kind of do the A round, in 4 months' time or whatever. So it does a bit depend on that sort of capital structure that you've decided to sort of deploy, and who your existing investors are, and they're happy with it, because sometimes the existing investors will be saying, look, we need to go out and raise money because you're going to run out of money in 4 months' time or 3 months' time, so they'll be putting pressure on you. You'll be like, look, I'm not quite at that stage to sort of go and raise that money. So there's a bit of a dynamic that goes on with sort of existing investors, and if it's just a founder, then that's something they're obviously sort of always debating themselves.
I think one thing I've seen done quite well is, sorry, I just keep using other people's examples. There's no original thought in the world, right? So one thing I've seen done quite well is where someone does like a one-pager update where they change the results and kind of what they've achieved, and they just send that out to basically every month. It's kind of keeping everyone warm, keeping everyone on side. Then a lot of American firms that we work with, who are obviously a lot bigger, the CEOs take like 2 days a month and they just block their calendars and say, or some do it like mornings or Fridays or whatever, and they just say to any investor, yeah, happy to do a 15-minute call to keep you updated. So they just keep that running as a process and almost embed it into the business. And I think that can work quite well, because it means you're not just going dead and then all of a sudden waking up and thinking, oh my God, I've got to all of a sudden speak to all these investors. Because obviously they're going to gain confidence in you if you're regularly updating them, you're sending them the figures, you're saying, actually, we've faced this roadblock. They'll then help you, because obviously a lot of them will feel bought into the business a bit more, and it usually speeds up the process in the examples I've seen at a later stage.
Yeah. And I think that's great advice in terms of, once you've closed that round, to not then just forget about your investors, to keep them warm, keep them informed, and then when you need to raise more money, they're more likely to follow on. And just one other thing, in kind of earlier stages, if you need some money now, but you don't want to kind of undervalue the business, you can potentially use advanced subscription agreements called a SAFE agreement in the US to get some cash in quickly, but only issue the shares when you do that round a little bit later on, normally offering some kind of discount to the investor for coming in early. And those can be SEIS and EIS compatible, although it's a little bit harder since the revenue decided in December, they have to convert within 6 months. Previously you had 12 months to convert. So I think we probably need to wrap things up pretty soon. Do we have any questions?
Do you have any additional insights for companies that perhaps based overseas, they're looking to come and raise money in the UK, or from Israel, India, Europe?
We've had companies and or spoken to companies like that, and certainly had clients from overseas. You tend to be, if it's like you're going to UK investors, they want to know that you've got boots on the ground in the UK, same way that if you're trying to raise money from sort of US investors who are based in the US, you need to have your sort of management team in the US. So the advice would be, if it's like an Israeli company who are wanting to raise money in the UK, it's got to flow with their kind of corporate strategy, their ambitions. So they're going to planning to open up an office which either the CEO or someone on that sort of management team is heading up. That would be where a lot of kind of UK investors would see it. If it's more pan-European, you can appeal to the sort of pan-European investors, and there are plenty of sort of Series A funds who've got a European-wide remit.
I think one piece of advice, again, super practical, is just making sure the deck is flipped, so it's in, just even culturally, but also, no one's heard of this name of supermarket, or no one's heard of this name of telco. The number one telco in Asia Pac is Telstra. Like, putting that into perspective, same with total addressable market, because people might look at the number and think, oh, that just looks tiny. I mean, that just looks like an insignificant market. But if actually in your home country, that is a huge traction you've managed to achieve, and your share is like 25% of that segment, put that into perspective for them so they can translate that TAM to whoever you're speaking to. Same in the US. Like, if you're a UK company raising in the US and you're going to Bessemer, don't frame your total addressable market as something that, our serviceable market is UK, because obviously that's going to look laughable. So I think just framing it through their lens would be one piece of advice.
Okay, I think we've come to a close on the panel debate. First of all, just to thank everybody and to say not only are these people very good at in terms of how they present and what they speak about, but I've worked with each of them. They all know their areas of business extremely well, otherwise they wouldn't be on the panel. So thank you, Carrie, thank you, Ella, thank you, Simon, thank you, the two Davids, and I hope you found that all very useful. We're going to break now to some more refreshments. Hopefully, if you've got any other questions, you'll ask them then. Thanks very much.
Thank you.